G'day and welcome to another episode of Perth Property Insider. I'm your host, Jared Mann, and today I've got John Lindeman from Lindeman Reports along, who's a bit of a guru in the industry. I've known him for at least a decade and followed his research. And how it came about today was I was looking around for someone who was an expert in what's happening in the markets with rising interest rates and inflation and the relative impacts that either of these may have on our property markets. And John had written a very interesting blog post that showed the direct correlations of each and went back into the history of how they've impacted our markets in the past. And I just thought, got to get him along to give you these insights, and it's great to have him on the podcast for the first time. Let's go inside.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management specialists servicing the whole of Perth. Now, here is your host, Jared Mann.
Hey, John, thanks for coming along today. Really great to have you on the podcast for the first time.
It's a pleasure to be here. It's been a long time since we've had a chat, so it's great to get together again.
Yeah, we were just working out how long it might be, and we've done a fair bit of work over the years. I know our clients have used your reports and continue to. So today we've got a pretty juicy topic, don't we?
Yeah, it's a pretty hot topic, I'd say, at the moment. Yeah, certainly.
Well, I was doing my own research on who can fill our listeners in on inflation and how it actually relates to the property market. And you would have seen, as well as I, that there's many bank economists at the moment predicting that house prices are going to fall this year. Some of them are saying next year, and they're all relating it to the rise in interest rates and interest rates starting to rise. When that happens, we'll wait and see. But I thought you published a really nice piece actually going into some of the correlations in history, because many of us haven't seen times where we've had inflation, and many of us haven't seen times where we've had rising in interest rates, have we? So
I think those of you that haven't, you're very lucky because I've gone through a few times when interest rates were up to 13%. It seems hard to believe, but even back in 1991, they were at 13%. So it does happen.
Before we jump into some of those things, because you're new to our listeners, give us some background on yourself and how you help property investors.
I'd love to, Jared. I think for those of you who don't know who I am, I'm a property market analyst. I've been doing this professionally for over 20 years. Some people call me the guru, people call me the godfather of property market analysis. But yeah, I've done it a long time. I've written 2 books published by Wiley's, Mastering the Australian Housing Market and Unlocking the Property Market, which were landmark bestsellers.
Yeah, very good books.
Yeah, and I do
They're
a lot
on
of
shelf right near me.
Thanks.
See the light blue cover of one of them.
Very, very popular because they tell it the way it is. And even though the first book was over 10 years ago, it pretty much hasn't changed in its accuracy in what is happening to us now.
Fundamentals, isn't it? And that's what I feel you can be relied upon. Yeah, it's not going to change overnight. The same things true today as they were then.
That's right. The fundamentals don't change at all. One of the things I did, and this is after we had our last get together, I invented a housing market prediction solution which identified the investment prospects for over 15,000 suburbs and towns in Australia. So it reveals their cash flow and price growth potential. Over the last decade, that's produced a consistent past predictive accuracy rate of over 90%. So when we publish reports and provide mentoring services and so on for investors, it's based on the reliability and accuracy of all the analysis that I've done. And that's the only patented predictive system in Australia for property investors. So
okay,
it's
great.
It's
a good one for investors to add to their research and overlay on the top of any other research they're doing.
Yeah, it's good to have tools and not rely on gut feel or hearsay, but use those tools. And there's quite a few out there. We're not the only ones that do this, but yeah, don't try and do it yourself because you'll come unstuck.
So when it comes to today's topic, Let's jump into it a bit. What sort of rise in interest rates is predicted, just to set the scene?
Well, historically, what the Reserve Bank has done is always, when it's increased rates, it's tried to do it as minimally as possible, so maybe 25 basis points. And then they've learnt to wait and see what happens, because if you wait a few months, it's not long enough to see what impact that's had. And of course, the aim of increasing interest rates is to try and control inflation, to slow the economy down a little bit. That takes time. So what I think they'll do is they'll probably increase by 25 points, then wait and see what happens. And if nothing happens, they'll do it again. So we could see a series of small rises, hopefully not too many, probably this year and going into next year. But I certainly think that 2% would be the most that they could possibly rise, because anything more than that, when people take out home loans, there's a buffer rate of around 2 to 3% built into that. So I think that people can probably withstand the shock. I mean, it won't be pleasant, but it's doable. But anything more than 2% will really cause some severe pain.
And so I guess relating into then, why do some economists believe that house prices will fall and take a big hit with these rates going up?
It's a common fallacy that people believe that house prices fall when interest rates go up, but it doesn't. And we can go into this in more detail, but a lot of the bank economists, will start to raise the, doom and gloom forecasts. They've already started to do this. And I think one comfort we can take in this is that bank economists' forecasts for property markets are nearly always wrong. So if they say that prices are going to fall, well, then we can be pretty sure that they're not going to.
Yeah.
But I think we need to rely more on just simply the fact that it'll be the opposite of what they say.
I have to also question, when they are coming up with these predictions, what part those predictions play in slowing things down themselves. Not so much the interest rate rises, it's almost the perception that comes before that happens and along the way as it happens. Would you suggest that has some impact as well? Yeah,
it could sort of make people pause and take stock and maybe slow down, and they can become what we call self-fulfilling. It does happen, but usually they're reluctant to do it because they then get the blame. People will say, well, it's your fault because you said it was going to cause house prices to fall.
Yeah, even when I look back on their predictions in the last few years, haven't they been way off in many respects? So
yeah, thankfully they have. So they said the housing market was going to fall as a result of the COVID pandemic and we would go into recession, and neither of those things actually took place.
So give us some background on what has happened in the past and the correlation between interest rates and house prices.
Okay, so what we've done, and if you go to my blog, I'll show you where that is later.
We'll put a link in the show notes.
You'll see it. I've done a number of graphs, and the first graph I did in the blog tracked the gradual fall in interest loan rates since 1990, and that's been accompanied by a steady rise in Australian median house prices over the same time. So it would seem that there's a correlation between falling interest rates and rising prices, but it could be an accidental correlation. And does it mean anyway that the reverse is true? How can we be sure that if interest rates rise, property prices will fall? So what I did was I looked right back to 1990 and track the actual times when the cash rate increased, so when interest rates went up. And they have actually gone up a number of times, but each time, like back in 90, 91, 92, they went up by a cumulative 1%. So again, it was a series of small rate rises, but the total was 1%. And then immediately after that, the Reserve Bank dropped the rates right back, and they went up again in 2000 by a total of 1.25%. And then after that, they dropped the rate back again. In 2006 and 2008, they went up by a total of 1% and then another 0.25% just before the GFC. But again, when all of these increases, and we look at the house price growth, there's been no negative effect whatsoever. In other words, these rates increases didn't actually cause housing prices to fall, none of them. The last one we had was in 2011. It went up 0.75%, and price growth, it flattened for a while and then it started to go up again. So they've really had no effect on housing prices at all. It's possible, of course, that prices might have gone up more quickly if the rates hadn't gone up, but the point is they didn't actually fall. And there's a very good reason for that, which a lot of people don't take into account. So would you like me to talk through that?
Yeah, again.
Okay.
I'm waiting on the edge of my seat here, John.
Right. The reason is very simple. We've got nearly 11 million properties out there, and 1/3 of all the housing in Australia is fully owned. That is, people don't have any mortgage on their property whatsoever. There's no remaining debt. Another third is properties that are owned by investors. Now, investors can claim the cost of housing finance interest against their other income. It's called negative gearing. So it means that if the cost of interest goes up, they just pay less tax as a result, which is a neat little arrangement. But
we've also got the tenant helping us, and rents are going up as well at the moment, and probably will continue to for a while.
Exactly. That's right. What will happen, they can raise asking rents on their properties whenever the leases expire to recoup the cost of any interest rate. So you've got 2/3 of our housing stock is completely immune or resilient to the effects of interest rate rises. So there's only really 1/3 of properties that have mortgages which are being paid off by owner-occupiers. Most of these people bought their homes many years ago when rates were much higher than they are now. So their financial situations have improved a lot. They've probably paid down some of their debt, and a rise in interest rates is quite manageable, doesn't motivate them or force them to sell their homes. So it really has no effect on property prices at all. So that's what the situation is. The vast majority of property owners, including investors and those that have paid off their mortgages, aren't affected by interest rates at all.
And so I guess, is there any suburbs or property types that would be more affected? I guess if we look through to who are those people that are most at risk of these interest rates rising?
Yeah, there is one unfortunate group which is at risk, and that is people who have recently bought their first home. They've probably, massively leveraged, so they owe 80, 90% of the value of the property to the bank. And they're probably, they've bought to the extent of their borrowing power. So that means that if interest rates go up, they're going to be in some difficulty. And that's unfortunately the history of interest rate rises. They always have affected first home buyers, recent first home buyers are the ones that do get impacted. And that's about 10% of the market. And I've looked at the last time that interest rates went up in 2011, there was a massive drop in the number of first home buyers. So they just didn't enter the market. And that can cause price falls in those areas because people aren't buying. And so the demand falls, and so prices do tend to go down a little bit. But all we're talking about here is those sort of outer suburban first home buyer markets, growth corridors for units, very, very small percentage of the market in total that is really impacted. And the other thing is that they do, because interest rates tend to fall again after a little while, that people, bounce back and get over it. And the housing market, even in those areas, returns back to growth again.
I guess people tighten their belts, and if they've been working towards that dream of home ownership, I know Michael Yardney often says, you're going to eat your Maggi noodles and, tighten things up as best you can. And the last thing you want to do is, sell your house and go back to renting, especially when rents are going up as much as they are as well. So.
Yeah, I mean, it's your home. And I know when I bought my first home to live in and rates went up to 13%, we had 2 young kids, and so it was pretty rough. And I grew vegetables out the back and got some chickens. And, we got one of these home bottling outfits. So we tried to save as much money as we could. But selling the house was just simply not an option. I would have got a second job or a third job, whatever it took. Now, I sincerely hope that those sorts of conditions never come back again. We might see some small rises in interest rates and it might cause people some difficulty, but, we really don't think that those sorts of conditions are ever going to come back.
So when it comes to the financial landscape, what actually causes property prices to fall potentially? What do we need to look out for? There's one thing that does cause housing prices to fall. And what I did was I studied the performance of the Australian property market. There's all capital cities combined right back to 1901. So it's when we became a nation, and I could get some data. I went back and looked at the times when housing prices actually went negative. And the first time that was during World War I. The second time was during the Great Depression. The next time was when we had a credit squeeze in the 1960s. Then we had the recession we had to have in the late 80s, which some of you may remember. Then we had the GFC
And most recently, we had the APRA tightening of credit for investors. So all of these things had one thing in common. It was a reduction in the amount of housing finance that was available. So in other words, when people, they just couldn't get housing finance, it wasn't that interest rates went up. That had nothing to do with it. It was because they were recessionary crises which cut the amount of housing finance that was available. So that affects all property buyers, that need finance. If they can't get it, they can't buy. And that's why the property market went backwards at those times.
Okay. So you touched on earlier why the Reserve Bank is increasing interest rates. Like, how does that fit into the bigger picture and why are they doing it?
Well, they're not doing it to punish home buyers or property owners. They're doing it because they haven't really got a lot of tools to slow down inflation. They see inflation as a big risk because of what's happened in the past, and it is. It's a terrible thing for a lot of people. So it means that they'll use whatever tools they have access to slow down inflation. And when they've done this, interest rate rises are the best tool they have, because what it does is it slows down the economy. And again, I looked at interest rate rises from 1990 onwards, and every time those interest rate rises occurred, the annual inflation rate then fell. So it does work. It's not a very pleasant thing to have interest rates go up because it affects all different types of loans, not just properties, but it's the tool that they use to try and get inflation down.
Okay. So I know a lot of us have got some idea of what inflation is, and it just seems like everything's increasing around us at the moment. So what is inflation as far as the Reserve Bank's concerned, and what are they sort of looking at, and why should we care about it?
Well, we should care because it affects people who can't cope with the increase in prices. So it's when shortages occur. So we've got a shortage of fuel, petrol at the moment, and we've seen that, that at the Bowser where the prices have gone up dramatically. We're seeing and will be seeing shortages in commodities like wheat. I'm sure the price of wheat will go up, and other minerals, especially because of the troubles in Ukraine, the conflict over there, which is affecting a lot of the availability of commodities and various resources such as wheat and so on. So with those shortages, prices go up, and that means, of course, you have to pay more for whatever you want to buy. This affects people on fixed income, so pensioners and people on various types of benefits that are paid as a fixed amount. They suddenly find that their buying power is reducing quite steadily. It also affects people who save money in the bank because it means that the value of your savings is being eroded.
It's not going to buy the same things.
No. So 10% inflation simply means that the value of everything has dropped by 10%. It's not a nice thing to say, well, hang on, I've got so much money in the bank, but now it's worth 10% less than what it was before. So because you can only buy 10% less than what you could before. Yeah, it affects different people in different ways. And the ones that can least afford it, like those on fixed incomes and relying on savings,
they might be getting a pay increase at work necessarily because they might be out of the workforce.
It also causes a lot of social conflict because when prices tend to go up first before wages do, and of course when workers want more money, the bosses say, no, you can't have it. And so there's strikes and all sorts of industrial strife as well.
And I guess people, when they're paying a higher price for something, just assume that business is making more. But of course, we've seen it in the building industry, especially the costs just to get everything, to transport it, to the builders aren't necessarily making that much extra when all their costs have gone up too. So
That's right. It's hitting everybody. Interest rates do, as the cost of living goes up, it affects everyone.
So why are, I guess, different investors attracted to holding property and debt when inflation rates are higher? How does that work?
Well, the simple reason is that there's a very strong relationship between capital city house prices and inflation, and housing price movements and inflation have always been in sync with each other. And the times when housing prices have moved more vigorously than inflation have been when inflation's been really high, like at the end of World War II when we had a massive rise in inflation. We also had massive population explosion. The house price boomed, it doubled in a few years, and of course it was much more than the rate of inflation. The same thing happened in the 70s and 80s when we had a period of hyperinflation, very high inflation, but house price growth actually exceeded that. It's always moved the same way. So, a good hedge against inflation is buying property, because property prices go up more than the rate of inflation.
I guess your debt that you've taken out on the property's fixed, and when you look back in even 10 years, if that loan is a fixed amount and no longer worth the same dollars in the future, then you've got it in past money, and it doesn't seem to be as much then.
And it isn't in real terms. The value of your debt has reduced, but the value of your asset has increased dramatically. So it's a good hedge, and it's much better. I would say that the only other option is to put some gold under the bed, because gold prices go up quite rapidly as well. But of course, you don't get any return on gold, just the capital growth.
So what sort of levels of inflation might be expected? I see lots of different numbers thrown around, and I know it's hard to predict, but what are you thinking from what you've seen?
Well, I've seen in the past, when we've had inflation of over 13%, they were extraordinary times, and I don't think we're going to get anything near double-digit inflation. I think there's other ways that it can be dealt with, and so interest rates is only, one solution. But I think that inflation could reach, 5-6% by the end of this year, and then, of course, it'll probably start to diminish again. So I don't think it's really something we should be overly concerned about. The problem, I think, is that a lot of people haven't experienced really any inflation at all. So the whole idea of, the value of money decreasing is quite disturbing.
I guess it's more just happened very, very gradually. And, we might have more of it going to pass in a year or two than we've had in a decade, potentially.
Yeah, I think that's right. And I think interest rates, will be going up a little bit, as I said. But when you look at the history of this, always remember that when the Reserve Bank has increased rates and it has the effect of reducing inflation, they immediately reduce the rates again. So it's a short period of pain, and it doesn't last for very long.
And I guess I'm also taking away just that more direct correlation of the house prices to inflation going up, and both of them going up together, not the correlation of house prices to interest rates. And that was my biggest takeaway from what you've said.
Yeah, there really is no correlation between interest rates and house prices, because, as I said, most people are immune. Homeowners don't have any mortgage, or investors who can cope with rate rises. So, whereas inflation infects all of us, and it certainly has an effect on the housing market, which is a very strong correlation.
So I guess, knowing all of this, what do you suggest investors consider for the next 1 to 2 years? And what are you doing yourself?
Well, I think the best, don't keep your money in the bank.
Yes.
Always, lock in the lowest possible interest rates you can when you're borrowing money. And the other thing is to go for areas which are going to deliver high cash flow, because you'll get the growth anyway. The growth, if inflation increases, then housing prices will go up as well. But you've got to really protect yourself against any rise in interest rates if you do have a large mortgage or an investment type loan.
Make sure that you have buffered in that extra potential 2% and have a buffer aside, so that, if the hot water system blows or other things happen, you're not ever caught out.
That's right. And try to look at areas that have got really good cash flow. Luckily, I think over the next few years, we're going to see a lot of people coming to Australia as refugees and migrants. Maybe tourism will increase as well. So we're going to see a lot of people arriving here, and I think that's going to increase the rent demand. Yeah. So buy in the areas where the rent demand is going to rise, because that'll protect you against the impact of interest rate rises.
Your reports are available for the whole of Australia, but certainly with what I focus on in Perth, our rental yields are pretty exceptional now when I consider how undervalued our housing market is. And it's beyond me how Adelaide can be priced. Most Perth people are very shocked that their median house price is some 60-odd thousand higher than the Perth median. So I think when it comes to cash flow potential and relative affordability, we're in a pretty good spot here for investment potential.
Yeah, no, I think that historically Perth's housing prices have always been higher than Adelaide's. So this is a bit of an aberration. And I wouldn't be too worried, for people in Perth. I think, every capital city has its time in the sun. So let's let Adelaide have a bit of that time, but it won't last, and Perth will recover. We'll get a lot of people coming in from overseas and stimulating that rental market, and investors.
It's crazy to me to think how tight it is at the moment, with the tightest vacancy rate I've ever seen in my 14 years of having the agency and 20 plus years of investing, it's kind of sad at how difficult it is for tenants. Like, I really do feel for them. We can have pressure on prices without like this crazy pressure, and it's only going to get worse when borders do open, and I guess ultimately that's going to mean higher rents. So
yeah, unfortunately that's how it works. But it also means that it encourages a lot of investors. People come in from the eastern states and
provide more of that rental stock, and we need it for them. So
that's
and I have noticed over the last month, especially, I think because Brisbane's hitting, it's really had crazy growth over the last year, and it's starting to become unaffordable for a lot of investors. And with the floods on top of that, it's put a fair few people off. So just in the last month, we've seen a considerable increase in inquiry from many of those investors that were looking to buy in Brisbane are switching over to here. So that's what I'm sort of seeing on the ground.
Yeah, it was, and we run a mentoring program, and a lot of students who are intending to buy in Brisbane, and they'd see like the price guide might say 800,000, and then when it went for auction, it'd go for some ridiculous amount like 1.2 mil. It was crazy. And so they've got finance organised and everything, and they weren't even in the ballpark. And I think that turns people off when they realise that a lot of the vendor expectations are just simply unrealistic. So in Perth, that hasn't occurred. It did occur during that big boom in 2010, 11, but it hasn't occurred this time. Prices are still very reasonable. So it's a good time to get into the Perth property market, I think.
So how can listeners get more help from you if they wish? You mentioned your report and helping choose suburbs, and you've got your mentoring as well that people can check out. Where should they go? And is there anything else that you haven't mentioned in terms of helping people?
Well, I think the main way I can help is if you go to our website, which is lindemanreports.com.au. So Lindeman, my name, Lindeman, reports.com.au. There's lots of blogs, podcasts, all sorts of information. It's all free. We offer people a free consultancy if they'd like that, if they haven't had one before. So they can have a chat with me for free for half an hour, but you have to book in for that, of course. So there's a lot of free information. Yeah, and you can have a look at our reports, and we do feature Perth. We do Australia-wide reports, but we always have some suburbs from WA and Perth in there. But you can have a look at a sample and so on. But look at all the free stuff, because there's a lot there. We've put a lot of value and effort into providing as much information as we can for free, because it's always been my aim in my property investing journey to try and help as many other investors as I possibly can.
Yeah, great. I'll be keeping an eye on the research that you do, and no doubt trying to get you back again sometime. It's great to get the perspective of those that can see things affecting the whole of Australia. And that's why I think our Perth listeners have a lot to gain from all your knowledge, John. So thank you so much for your time.
It's been a pleasure. Thanks, Jared.
For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. Just a reminder that the information discussed in this podcast is general in nature, as we don't know your specific situation. You should always seek professional advice before taking any action. I'll see you in the group.